stocks are down big this year. If you stop dollar cost averaging because of fear, you're absolutely being detrimental to your long-term financial future. Guys, I cannot stress this enough. When stocks go down, you have to stick to your plan. I highly encourage everyone to take 80 or 90% of their money and dollar cost average into low cost ETFs that follow the market, something like VOO or SPY. But do your own research. Every company is different on what they offer. These low-cost ETFs will basically match the market. And over 10-year periods of time, less than 10% of actively managed mutual funds with the Harvard MBAs and the experts out there that are supposed to be brilliant don't beat the market. So if you just buy the low-cost ETFs, you will crush everyone out there, over 90% of people. But obviously, it's scary to invest when stocks are going down. You get worried. Is this going to be forever? Guys, it will never be forever. If stocks went to zero, what would be the state of this world at that point? Your money wouldn't matter anyhow. It would be absolutely irrelevant. What would matter is who has the most guns, because you need to protect yourself. So stocks are not going to zero as a whole. There will be individual stocks that go to zero. That's supposed to happen. But as a stock market as a whole, it will not go to zero. So you need a dollar cost average. Here is what markets do. If you've watched our channel before, I show this all the time. This is the value of the stock market, but here's how the prices actually go. And if you dollar cost average all the time, you're going to overpay sometimes and you're going to underpay sometimes. But over long periods of time, you're going to pay this. You're going to match the market along the way. That is your job. But let's go look at the math to see how different it is. So let's say you invested all your money on the peak of the market of 2000. All that day, that was the absolute peak of the S&P. Until today, with dividends, you'd have made 6.75% return on your money. Now, let's say you also invested at the absolute bottom of the market, which was October 8th, 2002. You'd have gotten 9.3% per year, including dividends. So it's 2.5%, substantial difference. But guys, that assumes you only bought the absolute peak versus only bought the absolute bottom. But if you dollar cost average along the way, what would you have made? About 8% per year. Not bad for dollar cost averaging. Not bad at all. Let's take it a step further. Let's say you invested you kept that money in for the next 20 years. And for the next 20 years, the S&P only does 7% a year with dividends. The gap gets smaller. You go to 6.9% versus 8.2%. As time goes on, that gap becomes smaller. But if you invest along the way, good markets and bad markets, the gap goes away completely. Why? Because you're dollar cost averaging. And that is the key here. Let's go to another one. Let's go to March. Let's go to the real estate crisis, the financial crisis of 07 and 08. October 19th, 2007 was the peak. If you invested all your money on that date to today, you got 8.4% per year, including dividends. Now, let's say you bought at the low, March 9th of 2009. Big difference here, 14.1%. But guys, 8.4 isn't bad either. And if you got another 20 years, you know where the gap goes to? 7.6% versus 10.0%. Because there's a lot less history going back to 09. The numbers converge a lot smaller and tighter. But if you invest along the way, dollar cost averaging, you're going to get pretty close to 9% return on your money versus the market at 7.6. That's the key to dollar cost averaging. You cannot ignore this. It's absolutely key. You have to keep your money in the business, in the stocks. You have to do it along the way. In fact, we are working on something where I'm going to show that if you invest when markets are below their average and increase your amount that you invest, how well you'll do. You will crush the market. So it's that easy. Why does everybody do it? Well, guys, it's really hard emotionally. Look at today. S&P is down over 3%. NASDAQ's down 4%. This is a tough day, and it's hard to sit there and take the noise away. But that's why we have this community. This is exactly why I created this whole community of investors. Thousands of people in here talking every single day and motivating themselves and keeping themselves in the game. Because successful investing isn't about the numbers. It's about understanding the emotional side. When that pendulum is swinging from side to side, from euphoria to absolute disappointment and fear, it's important to stay in it all along the way. Take the guesswork out of everything. Save every single month, invest every single month without thinking, and you will do very, very well. So why even challenge that? Are today's numbers insane? Absolutely. The valuations today are insane. They're higher than they were back in the 2000 bubble. Maybe not now after the market has fallen 20%, but it's not way worse, but it's worse. But guess what? To anybody sitting in front of me, they said to me, Paul, I have 30 years, I have 20 years until retirement. What should I do? Dollar cost average. Take the guesswork out of it. When you take the guesswork out of it, you take out any sort of stupid emotional decisions you're going to make along the way. Because guess what? We all make them. I make them all the time. Now, you might be looking at me saying, Paul, I've heard in other videos, you're 95%, you're 97, 93% cash. Yes, but remember, my situation is different than others. I've got hundreds and hundreds of units of apartments. I have 8 or 9 businesses upstairs that all but one generate me good cash flow. I don't need to be invested. I can sit there and be more like Buffett and Munger, where I sit back and wait for the right opportunities and then go all in when I find it. Because trust me, I will be 100% stock at some point in the next few years. I will have 100% of my cash invested, and I will be consistent about that. But in the meantime, when I see this valuation so crazy, that's why I can pull back. But guess what? I'm not trying to save for retirement. I will never retire, and I could retire today if I wanted to. That's the luxury I have. But not everybody has that luxury. So it's important to understand that I am looking at this the same way, not trying to put myself in the same boat as Warren Buffett, but he tells everyone to dollar cost average. Someday, when I leave my empire to somebody, whether it's my nieces or somebody else, I will tell them, put your money in low-cost ETFs. That's all I want you to do. Take all the guesswork out of it. That is the key to everything. If you go back and look at every single recession and stock market fail where stocks went down 30, 40, 50, 60%, if you go back in time and look at those, you know what you just said? Man, I wish I invested back then. And that's going to be no different than when stocks fall even further than today. You will look 20 years from now, you'll look back and say, man, I wish I invested back then all along the way. Because we're not in the moment. Take it from me. Go back and look at the history of stocks. You would have looked back and said, oh my God, I wish I'd invested back then. But guess what? Back then, the world was coming to an end. There was no good things in sight, but that's what has to happen. The world has to look at stocks. The average person has to look at stocks and say, I can't make money. And that's when it's best to be investing. It's scariest, but that's when the margin is the best. That's when the margin of safety is absolute peak. And margin of safety is absolutely the most important thing to look at, because that's when you get the best deals. And when you invest in a low-cost ETF, you're investing in 500 companies that follow the market if you do an S&P 500 ETF. 500 companies, guys. 500 companies are not going under. 500 companies are not going under. Why? Because they're built on America. And unless you think America is going to zero, and if you actually do believe that, and you live in this country, you should absolutely 100% move away. It's not going to zero. This country is still a great country that has a lot of innovation. Are there issues? Of course. But there's always been issues, and there always will be issues. But we get through them, and we become better as a country and an economy. Even if we don't, you're still better off investing in a long-term ETF, because it's very difficult to pick individual stocks and stay with them as they fluctuate. But you can build that. In our community, we have people building their emotional fortitude to be able to do those things. And trust me, it is difficult. I still get it to this day. I have stocks that are now down 30, 40% from when I bought. And I have to go back there and say, okay, do I believe in these stocks? Has anything fundamentally changed? No. Okay, well then I should look at this as a buying opportunity. Because remember, price versus value. We want to buy when price is disconnected from the long-term value. So unless something has changed the company's long-term prospects, you should continue to buy. Same thing with stocks. And guess what? There'll be a lot of stories out there about why the long-term value has changed. But don't fall in for that emotional trap. In order to understand this best, you need to watch this next video on margin of safety, and then you'll understand better about how we look at our investments. Thank you very much, and please subscribe to the channel. The recent 12-year bull market has had very, very few interruptions. The biggest one was the pandemic.